Are defined benefit pension payments taxable? I'll be breaking this down for you in today's video, explaining the difference between the tax-free amount and the ongoing income that you'll take from that. Here at Cameron James, the majority of people watching the videos, 89% of you are not subscribed to the channel. Hit the subscribe button below, and if it's your first time to the channel, welcome. Okay, so to break it down, when you take your defined benefit pension scheme, you can typically take your tax-free amount from the scheme up to 25% of the scheme value, and obviously that is non-taxable. The same as if you were inside a SIP or a defined contribution pension, 25% of the pension pot can be taken tax-free, professionally referred to as your PCLS or your Pension Commencement Lump Sum. With a defined benefit pension, it's slightly different. Say you have a CETV of £1 million, doesn't mean you're going to get exactly £250,000 or 25% tax-free. It comes down to the actuarial rates and the calculations that have gone on at the scheme. Ask your scheme very clearly for what would be the total tax-free lump sum that you could take from your DB scheme, or of course you can roll it up into the pension pot to have a larger ongoing income. Now, the taxable part, we move on to the ongoing income. If you have £1 million DB and you take no tax-free at the beginning, say you're being offered whatever annual income per annum, let's call it £40,000 you're being offered per annum. That £40,000 would of course be classified as income. A lot of clients forget this. And they think, well, hang on a minute, no, this isn't fair. I've paid into the tax system all my life, why am I being taxed again? Incorrect. No. When your employer and you made contributions to your defined benefit scheme, those were extremely tax efficient contributions. Actually, for the majority of my clients, I have some clients with £1 million DB, the actual contributions they made to their DB scheme were pitiful in comparison to the contributions their employer made, which is why DB schemes barely exist anymore, because they're too good for employees and too bad for employers. But the money that's gone into it has been extremely tax efficient for you. For the whole of your life, it's grown tax-free with no capital gains tax applied, etc., etc. So now that you're drawing down that money, please remember it is income. If you take the example of £40,000, if you have no other income in the UK, you have your annual allowance, £12,570, the remainder of that capital will be taxed at your marginal tax rate in the UK, obviously starting off at 20%. So in simple answer, yes. Defined benefit pension ongoing income payments are obviously taxable, but the money at the beginning, the lump sum, is obviously provided tax-free. If you want to have a conversation with myself or one of our senior financial advisors here at Cameron James to talk more about your DB pension scheme, whether you want to find out about your pension payments, you're considering a transfer out, you're interested in obtaining advice as part of a two-advisor model, get in touch below for a free consultation. And as always, with DBs, with DCs, whatever it is, start a conversation. Do not feel like you need to stay at home and do all the research yourself. Get free advice from people. Well, you can't have free advice on DBs, but reach out to improve your education, your learning and your understanding before potentially deciding with a DB if you did wish to proceed in obtaining authorised and regulated pension transfer advice. And as always, take care of the UK pension assets.